Thanks for tuning in to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So let's start with what markets are actually doing. If you just look at the headlines, it still feels like it's a large cap story, but year to date tells us a different story. Commodities are up nearly 30%. Emerging markets and small caps are both in the mid-teens, and the S&P 500 is closer to 6%. So underneath the surface, this market is broader than maybe it gets some credit for. Now, that lines up really well with what we're seeing in the economy. Growth is holding up. GDP came in for the first quarter around 2%. But when you break it down, it's being driven heavily by business investment, especially that's tied to artificial intelligence or AI. Now, the consumer is still contributing just at a slower pace, and areas like housing are still lagging. So the takeaway here isn't that growth is weak. It's just that it's concentrated. And when growth is concentrated, it does tend to be a little more fragile. Now, that brings us to the Fed. They didn't move rates last week, but the bigger shift is in tone. We've gone from an environment where easing was the expectation to one where policy is more neutral and data dependent. There's also less agreement internally on what comes next, which tells you the path forward isn't as clear as it used to be. So the Fed is essentially in a holding pattern. Growth is fine, inflation is still a bit sticky, and they're waiting for clarity. Now, earnings have been a real bright spot, but again, with a familiar theme. The numbers are strong. About 84% of companies are beating expectations, and earnings growth is tracking around 27%. That would be the strongest growth in a few years. But that strength isn't evenly distributed. A lot of it's coming from a relatively small group of companies, many tied to that same AI investment cycle. Now, the encouraging part is that the investment cycle is being funded by internal cash flow, not leverage. But it does mean that the market is still leaning on a narrow set of drivers. And that shows up clearly in market structure. The US dominates global equities, and within the US, large cap growth still makes up a huge portion of the index, almost half of it. So when capital moves, it moves in size. That's why even small reallocations away from large cap growth that can drive a meaningful performance in other areas, and that's part of what we've seen this year. Now, if you look at participation, it's improving, but it's not fully where we want to see it yet. Markets are trending higher, but not everything is moving with them. So I describe this as constructive, but not fully confirming. And that's really the tension here in today's market. So when you step back, everything ties together pretty cleanly. The economy's holding up, but in a narrower way. The Fed is on hold, waiting for better clarity. Earnings are strong but concentrated, and markets are moving higher, but not with full participation yet. The interesting part is that what we're starting to see are early signs of broadening underneath the surface. And that's why our positioning remains balanced. We still like stocks in this environment, but we think diversification matters more than usual. And the moves we've made into small caps and international aren't about calling a shift. They're about being prepared if leadership continues to expand from here. So that's what we have for you this week. As always, I want to thank you for joining and wish you a great week ahead.